Hello, this is Jerry with Rocky Credit Union. This is part 4 of our budget series, and this time we'll be covering mostly mortgages because it's one of your largest financial decisions that you'll ever make. When you're buying a home, I want you to remember that you're buying it because it's a place you're going to live, you, your family, whoever. Don't think of it just strictly as an investment. A lot of people over the last several years have bought homes thinking, oh, I can flip it for this much. But as we've learned, housing prices don't always go up, and they certainly don't always go up predictably. However, when you're buying a home, you are paying money on your mortgage, and it's building up equity so that you actually own more of the home and have more that will be available to you when you go to sell it, versus paying rent where you just pay the landlord and the money's gone. The reason why you shouldn't think of it strictly as an investment is because of the long-term averages of what housing prices have grown at. From 1930 to 2001, home prices grew at an average rate of 0.7% per year, basically about inflation. In fact, from 1981 to 1991, people could buy a home in 1981 and they had to sell it for the same price in 1991. There wasn't even any growth in there. From 2001 to 2007, homes grew at a rate in price of about 8% per year. That's not a sustainable rate. Housing prices have dropped and then come back up again a little bit since 2007, but they are very high in comparison to what most of our incomes are, and so they may not, I'm saying may because I can't promise anything, but they may not grow much more over the next few years. We're more likely going to be closer to the long-term average. When you're choosing a home, make sure you choose something that's going to meet your needs for the next several years. If there's only two of you, you're buying your first home, just buy something that's a 3-bedroom. I know it is a little bit smaller, but with that smaller home usually comes smaller mortgage payments. If you buy something that's larger, in addition to the larger mortgage payments, you also have larger heating costs, usually electricity costs. Your property taxes will be higher, and you have to remember that in a poor housing market, it's the larger houses, the more expensive houses, that are harder to sell, and they lose the most value when it comes time to sell. If you have a smaller home, your smaller payments will allow you to put more money down onto expensive debts like credit card debt, or put extra money onto the house payment itself, or towards retirement. Mortgage debt is a long-term debt commitment. You're usually signing on for a 5-year contract at a minimum, and it takes about 25 to 35 years to pay off a house. It's not easy to get out of this long-term debt. You do have a mortgage contract, and there are penalties if you break it. Also, if you want to get out and you're trying to sell the house, that's not quick and easy either. So it should take a bit of thought before you buy your home. It's not just something you should automatically think of doing. You want to think of all the pros and cons. Now, it is a long-term debt, but you can reduce your monthly payments if you put a little bit larger down payment on, or go with the smaller home and have the smaller payment to begin with. It should be the longest debt you ever have, and probably the largest financial purchase you ever do. The annual interest rate is the lowest you'll ever have to pay versus credit cards or personal loans, but you pay for a long time. Now, because you are paying for a long time, if you make a few extra payments, especially in the beginning, it will really reduce the total amount of interest paid, and we'll show that with the math here right away. But if you can pay it off in 15 years, make extra payments, and you save like 10 years worth of payments, you can put that money that you've saved, those mortgage payments over that extra 10 years, into your retirement, or into your children's education, or vacation home, something else, where you're actually earning interest rather than paying interest. Now, it's February 2010. Interest rates are at a historic low. It's pretty amazing what rates have been for the last year. 2 years ago, the average 5-year mortgage was at 6.5%, which is actually a bit on the low side compared to the historical average. Now it's about 4.25%, which is a fantastic rate. The average 5-year mortgage rate since 1988 has been 8.5%, and since 1950 it's been about 9%. So we're well below normal. And if you know of anyone who bought a home back in 1981, well, mortgage rates reached 21%, which I can't imagine having to pay a mortgage at 21%. It would be pretty tough. Now be aware, rates are at historical lows right now. If you have a large mortgage and you're barely making the payment, when it comes time for renewal, the rates are going to go up, and they're going to go up fairly soon. What that means is that your payments are going to go up. So if you're making payments right now of $1,500 a month, and the rate goes up to, let's say, 7%, that means your payment could go from $1,500 to $2,000 per month. Make sure you can afford that, because it is the reality. So I'm going to show some math here, some of the differences with mortgages. Starting off with a $320,000 home with a $250,000 mortgage. It'll be 4.25% over 25 years. That sets your payment at about $1,354 per month. Pretty standard. Rates are going to go up, so be aware that when it comes time to renew, let's say you get a mortgage for this amount and this rate right now, in 5 years, what's going to be left on your mortgage is about $219,000, and the rate is going to be at 7%, and you have 20 years left on it. This is going to jump your payment up to $1,700, or a $350 increase on this mortgage. Just make sure that you can afford for your payment to go up by that much. We don't want anybody getting stuck trying to pay for a house that they can't afford, and that's why we encourage people to sometimes choose a little bit smaller. Just put this back to the way it originally was. And another thing I want to show is what doing a 35-year mortgage can do. So at 25 years, you'll pay $156,000 in interest. If you do that same mortgage, assuming the same rate's going to stay low for a full 35 years, which it won't, it will go up, but if you do it over 35 years, it drops your monthly payment by $200. Now, that can be incredibly useful, I do get that, but understand it raises your total interest paid to $230,000, or it's $74,000 more. So that whole 10 years that you're making payments, you've paid $74,000 more in interest than you did over the 25 years. That $74,000 is money that you could have been putting towards retirement and earning interest on that, or towards children's education, or other things that you think of as being valuable for you. I also want to show the effect of making extra payments every month. So $250 per month for the first 5 years equals it's $3,000 extra per year, $15,000 overall for 5 years, will change your total interest paid to $134,000 from, over here, $156,000. That means you're going to save, by making an extra $250 a month in payments over the first 5 years, you will save $22,000 in interest. That's interest that's a straight cost to you that you could be applying to other places that would be more valuable to you. So that's some of the math, just being aware of what a mortgage can do for you. It's long-term debt, so it adds up. Mortgage, it's a big decision. Buying a home is a big decision, and having a big house is nice, but be aware that having too big of a payment can be troublesome. Having too big of a payment now when interest rates are low can be a real big problem when interest rates go up and you have to pay even more. So that ends part 4 of our budget series around mortgages. In part 5, I'll be talking about purchasing a vehicle.